Welcome, my friends, to another edition of the Heritage Wealth Planning YouTube channel. Hey, I came across this article the other day from U.S. News and World Report that says, what you do if you file Social Security too early. I thought it was very, very interesting because as some of the languaging now and maybe some of the techniques are getting more and more kind of exposed out there to the pre-retirement scene, and maybe some of the fallacies that people have too, like, oh, I should take it at 62 because Social Security isn't going to be there, or I better take it at 62 because I'm going to die tomorrow, or the average life expectancy is only 78. I better take it at 62 because I might not live to the average life expectancy. All these things are fallacies. Doesn't mean they won't happen, but it means the likelihood of them happening to you as you're considering when to take Social Security are quite small. And so the problem that we have is that some people will file Social Security. They'll read some information. Maybe they'll even watch this video from me. Maybe they'll watch this guy, Devin Carroll. I forgot what his Social Security channel is. He does great stuff. I just forgot his channel. I might read a book or an article by Larry Kotlikoff over at Boston University. Side note, if you go to the Josh Scanlon podcast, I interviewed Larry Kotlikoff as well. And his website, Maximize My Social Security, I think like for $40, you can download the software and use it. It's called software as a service. So you're not really downloading it. It's just basically through the web, like almost like cloud. It's wonderful. I use that with my clients too. It's for me as a professional advisor, it's more than $40. But man, for the level of the deep dive that you get with Kotlikoff stuff, man, it's just phenomenal. Absolutely. So a big fan. If you go to the Josh Scanlon podcast, you can read or listen to the interview I did with Larry. Just great guy. He's done wonderful work in terms of Social Security research. He's the one, because of his prominence in the field. Make sure my mic is up there. He's the guy who made the Congress and Obama get rid of the old file and suspend. File and suspend is no more, because Kotlikoff is the guy who wrote about it in his book, Get What's Yours. So I can't remember the title of it, but Get What's Yours, I think it was what it was, where he talked about file and suspend, and that just took off like and because it took off so much and it grew like weeds, so many people are doing that technique that Congress said, whoa, we didn't mean for that to happen, so they got rid of it. So thanks, Larry. But anyway, so he's done just seminal work on Social Security. At the end of the day, though, you might have heard some crazy guy say, you better file at 62 because you're going to die. Your average life expectancy is 78. Social Security might not be there, blah, blah, blah. They'll say Trump or Obama or whoever. It doesn't matter. All politicians, if you're on the Democratic side, you hate the Trumpster. If you're on the Republican side, you hate Obama. You want to blame them all. When it's so much more than that, my friends. It's so much more than Trump or Obama. It goes well beyond Trump or Obama. The facts are Social Security used to have 16 workers per one beneficiary, and here pretty soon it's only going to have like 1.5. I think it's like 2 now, and it's not sustainable in that regard. It just is not. And everybody knows it's not. The question is, are any politicians going to want to pay the price politically to fix it? And the answer is probably no. So with that said, there are some issues with Social Security. I'm sure there'll be a commission that will study, make recommendations, and the commission will be granted authority they don't have constitutionally to raise taxes, increase the retirement age. That way the politicians don't have to, take the blame. But at some point that's going to happen. But even right now, even the Social Security, the folks who analyze it even say, at the end of the day, we're fine until about 2035. And then we're going to have to cut back, say, 20 cents on the dollar. So it's not like it's destitute. It's just it won't give you the full benefits. And frankly, they need to raise the retirement age. There's just no getting around that. They need to raise the retirement age to keep up with the fact that people are living longer. Okay, so with all that said, say you said, I filed for Social Security too early and I want to reclaim that. What can I do? There used to be a pretty good strategy before the Obama and the Republican Congress, the bipartisan fixes to the Social Security system in 2015, where you could pay it all back without interest. Essentially, you had an interest-free loan for as long as you wanted, and you could just pay it back and then start taking your delayed earnings credits, which is pretty sweet. So if you filed at 62, let's say you got $30,000 of Social Security, which you just banked, and now you got $5,000 of interest off that. You can say at 66, you know something? I don't want that Social Security. I'm going to send them a check for $30,000, and I'll keep the $5,000 of interest that I've accumulated. That worked. You could do it. And then on top of that, you could allow your benefits to grow with the delayed earnings credits up until you're 70 years old. It's wonderful, but you can't do that anymore. So those days are gone for that. I do hear on occasion people still asking about that. I think I've used that twice with clients back in before they got rid of that rule back in 2013 and 14. I think we did. I've only done that twice. It wasn't very prominent. All right, so here's a guy, Jeff Williams. I'm not familiar with Jeff, U.S. News and World Report. And he says, what to do if you file for Social Security too early. So let's look at what old Jeff says. And again, I'm not familiar. Let's see what his byline says, if it says anything here about who old Jeff is. So I'm not familiar with him. Doesn't mean that he's not righteous or doesn't know what he's talking about. I just, generally speaking, there's some people I get familiar with and others I don't know. And my thing is giving me a hard time. Yeah, I don't see anything for a byline here. Okay, so let's look and see what old Jeff says, though. It'll be interesting to find out. All right, so we'll see if he has a byline someplace on here. I guess not. Okay. Nope. Nope. Okay. So there's no byline on Jeff. I guess I could click on that, but given how slow my Wi-Fi is working, I'm not sure I want to. So, all right. So maybe you're overconfident, or perhaps you felt that you needed the money now, but have some buyer's remorse. Exactly. You've read an article, you've seen a video, your brother-in-law told you blah, blah, blah. Or even worse, you realize that at the end of the day, when you look at the taxes on Social Security relative to the taxes on RMDs, required minimum distributions, Social Security is much more favorable and Social Security is guaranteed. So you say, yeah, that sounds better. And Social Security leaves a surviving spouse a significant benefit that your IRAs may not. So you might say to yourself, I need a do-over. It's a common dilemma, according to Kate Stalter, co-owner and senior financial advisor of Better Money Decisions, a financial services company in Albuquerque. Surveys and statistics back her up. Saying the vast majority of people take at 62, which is before the full retirement age. This is 100% correct. While the trend to file for benefits later in life, according to a 2017 study from Fidelity, 28% of Americans still plan to file as early as possible. That seems awfully low to me, actually. 28% of Americans still plan to file at 62. Now, I don't believe that. And the reason I don't believe that is because the people who file for benefits at 62 are overwhelmingly the majority of people. It's not 28% by a stretch. It's way above that. So my inclination is they might say they plan on delaying it, but as that number approaches of the age of 62, they might say, you know something, the reality is I might not live, and I'm going to file so I can get something. And it's hard to argue against that, frankly. I mean, that's the fear of the unknown. I don't know what's going to happen. I want to get my benefits so I get something out of it. You can, give me all the research and the statistical analysis and the Excel spreadsheets. At the end of the day, though, if I keel over tomorrow, I don't have any Social Security benefit, and I don't want that to happen. Just on that alone, it's hard to imagine that most people won't file at 62. It just is hard. Unless they have a law that says at the end of the day, you can't file until your full retirement age. And again, I don't think Congress will ever pass that law, and the president will ever sign it. All right, so if you feel you're taking your benefits too soon and wondering what you should do, here you have some options. Okay, so first, familiarize yourself around the retirement benefit. We already talked about the earliest you can file, basically 62 years old. You actually file at 61 years and 9 months because they need a 3-month time for your benefit to kick in. But that is the earliest you can receive a benefit is at 62. And then we talk about you will receive less money if you file before your full retirement age. I mean, this is all stuff if you've been watching my videos, The full retirement age is 67 if you're born in 1960 or later. We already talked about that. 66 if you're born before 1960. And 66 in some months, depending on exactly what year you're born after 1954. So here, which is what we talked about. Man, we talked about, I've had a couple of people that had given the money back they'd taken on Social Security. It was interest-free. Now, they've accumulated many years of Social Security, and they were able to pay the whole thing back, $30,000. You can still do that as long as the benefits claim has been less than a year, okay? So as long as you've only had the benefit for less than a year, you can give back the amount you've accumulated back to Social Security. And here's what Jeff says. All you have to do is submit in writing that you would like to withdraw your claim for benefits. Then you go back to not receiving your Social Security and wait until a later period when your benefit payments will be higher. The bad news, you have to pay back all the money you received from Social Security, including any payments made to a spouse or child. That may not be too hard if it's just been a month or so. But if it's been several months, and you're on a fixed income and money's tight, it will be kind of hard, without question. So remember, let's just say you're making $2,000 a month, and 6 months goes by, and you say, I need to pay it back. You take out your trusted calculator, $2,000 a month times 6 months is $12,000. You got to stroke them a check for $12,000. No interest is needed. And then you don't get the benefits. Not only are you out that $12,000, but you're going to be going forward the money that you're receiving on a monthly benefit, because you're saying, I don't want it right now. I want to postpone my benefits essentially and allow my benefit to grow to my full retirement age or more with delayed earnings credits. So it's a winning scenario in the long run, but if money's pretty tight, it's gonna be hard to do that, my friends. All right, let me pause just real quick. I need to start doing this a little bit more. I keep forgetting. I watched this guy. If you're like YouTube and you're wondering how to do YouTube, there's a guy named Brian G. Johnson that I'm a fan of, and he says make sure you tell people to subscribe. So let's pause. Subscribe. All right. So you see the little subscribe button down there. Make sure you subscribe. Okay, so we got with that. We're going to do that a couple of times. I'm trying to practice my encouragement to get people to subscribe. I usually wait to the end of the video, but if you look at my video metrics, most people watch pretty good amount of time, which is pleasing to me. Not that many watch to the very end, though, because I do long videos. I get that. But so don't forget to subscribe, my friends. Okay, so back to Jeff's paper here. Suspend your benefits. If you reach your full retirement age but aren't 70 years old, you can contact Social Security and ask they suspend your benefit. At that point, you receive a higher delayed retirement credits, delayed earnings credits, we call it, DRCs, they call it, it's fine. Same thing, which are worth 8% a year. All right, so what's going to happen here is you say you got $30,000 of benefits over the last 2 years. You say, oh, it's just suspend them, but I'm not going to pay it back, just suspend them. And they will stop paying you your benefit to allow your earnings credits to kick in at the 8% a year. Now, remember, if you reach full retirement age, that's when you have your full PIA, primary insurance amount. Okay, so full retirement age, 66 or 67, depending on exactly what year you were born. That's the only two numbers you got to remember, 66 or 67. And you only need to remember 67 if you're born in 1960 or beyond. All right, so if you hit your full retirement age and say, I don't want my benefits after all, suspend them, they'll stop paying you, and they'll allow your benefit to kick in with the delayed earnings credits at 8% a year. And then you can go back, you can take it at 68, you can take it at 69 or 70, whatever the situation dictates. Let's see here. If you aren't at full retirement age, start working again. Man, this is a good strategy here too. I think this gets overlooked quite a bit. Now, I've shown you in previous videos on how to maximize your Social Security. Remember how this works. They look at your average index monthly earnings, your AIME. They're looking at your AIME, which is your top 35 years of earnings. They're looking at your top 35 years of earnings, adding each of those up each and every year, and then they're dividing that by 420. So one way to increase your earnings, your AIME, is to have another year of earnings, especially if you have a year of high earnings that will replace a year of bad earnings. So you just inherently dropped off the low. Remember, it's almost like grading on a curve. You dropped off the lowest, you added the highest. That will inherently bring all your benefits up. Now, it might not bring it up much because you only have 1 year out of 35, but you got rid of a low one, and you added a higher one. So it's a double whammy there. Again, it won't be a huge amount, but 20 extra bucks, $25 a month, that's real money. And so, like Jeff is saying, if you aren't retired at full retirement age, keep working or start working in. If you aren't yet out of your FRA, you could work while you receive your Social Security benefits and see higher earnings later. I would challenge that to some degree, that you probably don't want to take your Social Security benefits while you're working, not because you lose your benefit. For the love of Mary, you don't lose your benefit. They just withhold a portion of your benefit in which to pay you that benefit later with a higher monthly payment. So it's not, you don't lose it. So I don't have any problem with people working while they're claiming benefits before they hit their full retirement age. But if you're working, well, do you need the benefit anyway? I mean, you might. But if you don't, then don't get your Social Security benefits because you're earning money that you can use to put food on the table, and you're drawing a benefit that's being reduced from the rest of your life, but all the rest of the life of your surviving spouse as well. So if you start at 64 years old and you took benefits early, You say, you know something, this isn't working out like I thought. Suspend your benefits. Suspend them right now. That way you can stop the reduced benefits right then and right there. You allow your benefits to kick in to grow at that 8% a year from the day you started taking them. And if you wait till you're 66, 67, 68, you increase your benefit by that amount times 8, by that many number of years that you delayed times 8, which is wonderful. All right, so 3 years, that's a 24% increase. Then if you start at 64, you can figure this out. If you start at 64, you stop your benefit. You start your benefit at 62 and stop at 64. You have a reduction in benefit. If you stop it at 64 and go back to work, all right, so now 64 goes, 65, 66, 67, 68. That's 4 years of not retaking your benefit. 4 times 8 is 32%. You increase your benefit by 32% from what it was when you're at 64. And then you're also going to have cost of living adjustments as well, my friends. That's a big deal. That is a big deal. I show you in other videos how the cost of living adjustment gets way overlooked in terms of Social Security. People don't realize it, though, but the cost of living adjustment starts this yawning gap. Here it is right here without a cost of living adjustment, with a low benefit and a lower cost of living adjustment, higher benefit, and again, a higher cost of living adjustment in pure dollars, the same percentage, but in dollars, it gets larger and larger and larger. The larger you wait, the longer you wait, the more the cost of living adjustments actually puts money in your pocket. All right, so I'm telling you right now that COLAs are a big deal. The more you wait, the more Social Security benefit you have, the more those COLAs actually give you in pure dollars that it goes back into your pocket. It's amazing how that works. Just watch my other videos on how to maximize your Social Security to see what I'm talking about there. All right. So now you say, I'm 64. My first 3 years of work that were in my 35 years of my average index monthly earnings, I wasn't making that much. Man, I was washing dishes at, Olive Garden or something like that. If there's any way I can reduce those or even eliminate those 3 years, instead replace it with a year where I'm making real estate commissions or whatever it is, I'm replacing a $30,000 a year on my AIME, and I'm replacing with a $90,000 a year as a, computer salesman. I don't care what it is. That is a win. You're going to get a $90,000 on AIME, and you're going to get rid of that $30,000 and that when you had a bad year that year. So, and that's a huge win. On top of that, because you stop taking your Social Security benefit, you're going to get an 8% improvement each and every year until you redo that. It's a wonderful strategy. So good job for Jeff for bringing that out. If you claim benefits too early, don't beat yourself up. 100% agree with that. Social Security can be complicated for anyone, says David Demko, a clinical gerontologist based in Jacksonville, says that he decided to file for Social Security too early. Even experts on senior issues can make mistakes that result in perplexing consequences. Yep. He took his benefits at 65, but at the age of 67, he wound up refunding his benefits and posting until 70. But at the age of 66, 68, he reversed his decision, and the Social Security Administration paid him back what he had refunded. Come on, man. That's a lot going on there. Sometimes we can overthink this stuff. He isn't wishy-washy. There you go. They're reading my mind. They're saying he isn't wishy-washy. He just had a lot of life choices to make. He had some health issues. Okay, I see what this guy did, including mysteriously losing 55 pounds in 6 weeks that made him think he wouldn't live until age 70. Okay, so I take that back. Sir, you're not wishy-washy. You didn't overanalyze that. I take that back. Losing 55 pounds in 6 weeks would make me concerned that I would lose my benefits as well. And that made him think he wouldn't live until age 70. And that's a consideration. If you think you're not going to be long-lived, then take your benefits ASAP without question. Remember, though, I would say at the end of the day, I don't know if this guy's married or not. There's a second part of this. If you are married, what are you going to leave your surviving spouse with? And I'm not going to get in that here, but just keep that in the back of your mind. You might not be long-lived, but that doesn't mean your spouse won't be. And if she's long-lived and you're not, and you took too early, that could really put her up against it. You definitely want to think that through. Don't be afraid to seek advice. Demko says return the money to Social Security. Was a nightmare. Literally, it created an IRS tax return nightmare. Yeah, I bet. That's why Gottlieb's advice would be smart to heed. If you feel you made a mistake or just aren't sure and you want to make a change, Find an expert in Social Security planning. The way I look at it, folks, if you feel you made a mistake, I wouldn't pay money back, frankly. I just, you only have 12-month time. This Mr. Demko must have did it before the new laws kicked in 2015, because you can't do it over 2 years. It only has to be in the first year you file. I wouldn't return it. I just keep the money and then allow the delayed earnings credits or the 8% annual growth to kick in from then on. Return the money. The two people I had to do that, it was more of a hassle than you think. It wasn't that big of a deal, but it wasn't a walk in the park. I mean, you're dealing with a federal government, my friends. They're going to get a check for $35,000. You'd be like, what? I mean, how many checks of $35,000 has the IRS received from, or Social Security Administration received? Yeah, not many. All right, so it may cost you up front to consult an expert, but if you make more changes with your Social Security account and don't fully understand what you're doing after filing too soon, opting not to work with a professional may be the second biggest mistake you make. Okay, so that's a good sales pitch, I guess, for what we do in this line of work. All right, so at the end of the day, what to do if you filed for Social Security? The two things. If it's in the first year, you can pay the money back, all right, and just stop your benefit. That's fine. That's number one. Number two, if you took too soon and you're filing benefits now, just stop. Say, don't pay me anymore. I want my earnings, my 8% to grow. Call them up. I don't know if you have to go down there. Just call them up. Say, I want to stop my benefit. I took it at 62. I'm 64 now. I want to stop my benefit. You don't pay it back. You just say, I'm not going to get it anymore. Again, you might need to look at your cash flow. That might be easier said than done. That'd be something for you to decide. But that's number two thing you can do. Number three, I'm going to stop my benefits and I'm going to work. All right. So that way I can earn more money that I will, to pay for my living expenses, so I don't have to draw my Social Security, so I can allow my Social Security to get those 8% each year improvements from the previous year up till I was 70. And B, if I have low AIME on the first part of my working career, I can get rid of some of those low years of earnings and replace it with a higher year of earnings for sure. And that's where you got to know your AIME, my friend. Oh, stop. Subscribe. This is going to be awkward. Subscribe. So right down there, my subscribe button. Don't forget to do it, please. All right. And also thumbs up, like I always say. It occurred to me that no one's really at the end of my videos, as I said before. So I need to say it and throughout just to get you excited to subscribe to the stuff. All right. But anyway, at the end of the sorry, guys. At the end of the day, make sure that you look at your AIME, your average index monthly earnings, that 35 years of cash flow, your earnings cash flow that you see. And then you say to yourself, I'm 64. It doesn't have to be 64. It can be whatever age you want. It won't be after 70, but you say, I'm 64. I made $35,000 when I was 25 years old. It's in my AIME because it takes my top 35. And this year I'm gonna make $60,000 on washing dishes because of inflation. Whatever. If I do that, I'll make $5,000 a month, which means that will be more than enough to live on, which means I don't need to take Social Security, which means if I don't take Social Security, I can continue to get 8% a year on my Social Security growth from when I did take it. And on top of that, because I'm working with a higher income, that higher income will be added to my 35 years AIME and will lop off the bottom of my 35 years AIME, and thus I make more Social Security. It's a wonderful strategy. That's probably my favorite strategy right there. All right, my friends, hope this helps. Thumbs up. I already told you to subscribe, so I won't tell you it again. I just did. See that trick? I won't tell you to subscribe again, but I just did. Thumbs up are always helpful, my friends, without question. I'll put a link to this article in the show notes at US News. Hopefully, look at it. I think you'll find it pretty interesting for sure. There was no place for comments that I could find. That's too bad because I would have liked to have seen some of the folks who asked questions on this stuff. And then, but do put your comments below. You have any thoughts or any workings with Social Security Administration? So I interviewed this woman named Liz Hand, who's a financial advisor out in Canton, Ohio, and she's on my podcast, episode 40, I believe, podcast episode 40. And so I interviewed her, and she's gone to the Social Security Administration twice with clients, and she says fine. So the people there, it wasn't like going to the DMV. It was fine. The people there are helpful, knowledgeable. Now, they cannot give you specific advice. They're not tasked to do that, but they can say, based on this is what we're looking at today, this is how you max your benefit today, not future forward looking, just what is the way to max my benefit today. They are tasked to do that, and they do that very well. Now, I always thought they're doing that as under some consideration that they want people to take now as opposed to delaying. I don't think that's the case anymore. I think actually what it is the case, they look at your numbers, they say this is the way you can draw your most amount of benefit today, and they make that recommendation, not even a recommendation, they make that observation, I guess, is the right word. And because that's helpful, but there's more to the story here, and you really need to dive into it. And the first place to do it, my friends, look, for the love of Mary, at your AIME, your average index monthly earnings. Look at it. Look at it. That is what everything is driven off, your AIME. Make sure that puppy is correct. All right. Subscribe, comments. Don't forget to hit the little notification bell down there. And, of course, the thumbs up is always helpful, too. We'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.